You might have heard the term earnings quality before, and it might seem a little bit confusing. You might just think, well, hey, we just have earnings, we just have net income, and that's calculated by the firm, and it's kind of verified by auditors. What's the deal? Why would there be high quality and low quality earnings? So it just doesn't make any sense. So I'm just going to talk briefly about this in this video, and I hope by the end you have a better understanding. So firms face pressure. So you have say you have this firm here. This firm has pressure. It's pressure put on the firm to do certain things. Right? So I'm just going to talk about a few of those things. One would be to meet or beat analyst targets. Right? Meet or beat targets. So analysts follow the firm. Right? If it's a large firm, it has multiple analysts following it. And basically these analysts come up with an idea of what they think earnings will be in a given quarter. And if the firm doesn't make that target, if it doesn't meet this target, then there could be repercussions. The analysts might decide that they want to downgrade the stock and say, okay, well, I think this stock should be a sell or something like that. And that ultimately comes back to management in terms of this pressure, because they might ultimately end up getting fired or something because they're not basically meeting or beating the targets, right? So there's a lot of research showing that if you don't meet targets, there can be financial repercussions for the firm, and basically suffice it to say the firms have a very strong incentive to meet those targets. And then the second thing that firms face pressure with is basically compliance with lending agreements, with these things called debt covenants, compliance with debt covenants. Now, debt covenants are basically like you might have a firm borrows money from some lender and it says, okay, we agree that we'll make sure that our EBITDA is a certain ratio of our assets or a ratio of basically they somehow make kind of these promises about financial numbers and what they promise to maintain. And basically, if they don't make that promise, if there's some kind of a problem, then they ultimately can have the lender can come in and call in the loan. And so, again, you've got this pressure to comply with these debt covenants. And then kind of on a broader level, we can just think in general with the way the stock market views a firm. Basically, there's just kind of this continual pressure to constantly show growth. Right? The market rewards and the market wants to see growth. Now, here's what I'm talking about. Let me just draw a little picture, and I'll give a couple examples. So when we take a look, let's say we have earnings on this axis, and then here we have time. So what the market wants to see is it wants to see over time earnings are going up. They're nice and smooth. That there's just nice progression. The earnings are always going up. But the reality is that, hey, things happen. And it's not exactly that the firm's earnings are going to increase by some constant rate or 10% or what. The firm will have problems, right? It might lose a major customer. It might have so in reality, we know that probably earnings might look more like this, right? They might be very volatile, right? So when we look at really these two things, we've got kind of a smooth idea of earnings, and then we've got more volatility. Now, basically, the market wants to see this smooth. It's a lot more reassuring, right? Especially if you think of volatility. Let's say that the volatility was something like this, right? So now if it's right here at this point in time, the market doesn't know, is this going to continue to go down or does it come back up? I mean, this is just this drastic changes. And so it can be scary. People don't want to invest. They don't want to be any part of that firm. They think that it's high risk. They associate volatility with a lot more risk. So they want to see this nice, smooth progression of earnings. But if the firm is more like this in reality, well, what is the firm going to do? Well, the firm is going to it's going to manage its earnings. So now we come into this thing called earnings management. Let me write this out because this is very important. This idea of earnings management. Now you might think, well, how do you manage earnings? How do you? Because basically what we're talking about here is kind of manipulating the numbers, and I'm not talking about fraud. Although earnings management can, if it becomes very aggressive, it in some cases ends up being fraud. But I'm just talking about basically a firm timing its transactions. So it's timing its transactions to produce gains and losses, to kind of manage or smooth out earnings. So it's timing transactions, right? So you might have some unrealized gain on some asset that you weren't thinking of selling, and you say, oh, okay, well, our earnings has been like this, but now it's gonna level off, or maybe it's gonna go down this quarter, and we're worried. We don't want that to happen, so we go and we sell some asset that we otherwise wouldn't maybe sell to get an unrealized, or to realize a gain, and then keep the earnings going up. So basically, we're timing transactions. We're saying we're going to do a transaction in such a way that we ensure that the earnings keep going up nice and smooth, like investors want to see. So now it's very important that when we think about this idea of earnings management, we understand that this is kind of the root cause of why we talk about earnings quality, and some firms having low earnings quality, some firms having high earnings quality. So when we think about this, we think high or we think low. Just think about it like this. So when a firm engages in earnings management to a really significant extent, let's think about a firm that really is kind of playing games and timing transactions to make the earnings number meet a certain target. We would say that firm has low earnings quality. That doesn't mean that firm is engaged in fraud or that they're going to be sued by the SEC or something like that. Basically what we're talking about when we're talking about earnings quality, I'm kind of thinking about, let me just put here, we're kind of thinking about the reasonableness or trustworthiness. Just basically think how transparent, how trustworthy is that earnings number. So when we look at net income on that income statement, and we look at that and we say, okay, here's net income for the quarter or for the year, how much of that is that the firm just generated that income, and how much of it was that the firm was just timing transactions? If most of it is kind of this financial engineering, these games, then we say that firm has low earnings quality, right? And like I said, this isn't fraud. This isn't saying the firm is going to go bankrupt, right? Because most firms engage in earnings management. So we kind of think of it as overly aggressive earnings management. Like, for example, when you get to a point where you're actually recognizing fictitious sales or something like that. Now, of course, that's fraud. And we're not talking about that here. That certainly can be a component. We'd say you have low quality earnings if a firm is engaging in fraud, obviously. But what we're talking about when you hear earnings quality, a lot of times there's people who are talking about how reasonable, how trustworthy. Look at the trustworthiness of that bottom line number, that earnings number that we see on the income statement. How trustworthy is that? How reasonable is that? What's the quality of the earnings? Is it high or is it low?